All right. Well, thanks everybody. I'm Ken Crossan. I'm a wholesaler here out in the Greater Toronto area, and my pleasure to introduce Dave Paterson today as well. Thank everyone at IDC, excellent partner with us over the years, and thanks Don for having us on today. Um, Dave Paterson is our Vice President in Strategic Investment Solutions. Dave joined Empire Life a couple of years ago now in 2019, and he's responsible for the management of the new Empire Life Multi-Strategy GIFs. This is a suite of segregated funds which provide exposure to ETFs, actively managed investments, and third-party managers that Dave will definitely dig into today. We just actually added to this lineup over a week ago and round out that now to 8 offerings on this platform. I'm just going to take a second as well to mention that we also launched the Empire Life Global Sustainable Equity GIF, which focuses on the environmental, social, and governance aspects of investing as well, just the other week as well. Dave most recently was the Director of Public Markets and Research and Analytics at a registered portfolio management firm, where he was responsible for the sourcing, evaluation, and ongoing monitoring of investment products. He was also a portfolio manager of a fund-to-funds portfolio program for registered third-party dealers. So since 1994, Dave has specialized in investment fund research, performing ongoing analysis of thousands of mutual funds and exchange-traded funds. He produced a monthly investment fund ranking report that you guys might have seen, and it was a ranking of mutual funds, had a focus list, as well as an ETF focus list report. Dave has a Bachelor of Commerce degree and is also a Chartered Financial Analyst charter holder. So at this point, Dave, I will hand it over to you.
Thanks, Ken. And as always, thanks again, everybody, for taking time out of your day to listen in. So hopefully you can see my screen now. I seem to have lost everything.
Yeah, I see it.
I'm really good at this technology thing. So there we go. So anyway, what I'm going to do today is talk a little bit about our new multi-strategy lineup. First, I want to give you a broader overview of the multi-strategy products as a whole, and then delve a little bit deeper into the new growth funds that, as Ken mentioned, we launched last week or the week before. I don't know about you, but I've been in my house since March, so it's all kind of blurring together here. Fortunately, it's Groundhog Day. But as Ken noted, I have been in the mutual fund business since 1994, most of which has been spent as an independent analyst focusing on mutual fund, ETF, and hedge fund research for financial advisors, as well as working with advisors and helping to build better portfolios. And so about, I guess, coming up on 2 years ago, I joined Empire. And really what was really exciting about the role at Empire was the opportunity to really help expand our product shelf. And if you know Empire at all, we've historically run all of our money internally with a real focus on a very fundamental bottom-up value tilted approach. And a couple of years ago, we decided to move to really expanding that product lineup and bringing in different styles and strategies and really diversifying our product lineup. And the multi-strategy funds were really the first launch into that. And, you know, when you talk about multi-strategy investing, what exactly does it mean? Because I'm sure it can mean different things to different people. And, you know, the way that I define it is it's really more a blend of incorporating different investment styles and strategies into a one-ticket solution. And so we really try to blend passive strategies, smart beta, and active strategies into one solution. And the rationale is that different investment styles and strategies are likely to perform differently at different points in the market cycle. So in terms of the funds that we launched last October 2019, we brought 3 equity portfolios. So we have Canadian equity, US equity, and a Go Anywhere global equity fund. As well, we launched 3 sort of global balanced portfolios: conservative, balanced, and a moderate growth. And building on that, in the last couple of weeks, we launched 2 new very high growth focused portfolios: the Empire Life Multi-Strategy Global Growth GIF and the Empire Life Multi-Strategy Global Growth Balance GIF. So in terms of how these are put together, it's really kind of based on the overriding philosophy of how I build portfolios. Having been fortunate enough to work with advisors over the past 20 some years, you really get a sense of how a lot of advisors put portfolios together. And you go out and you find what you believe to be a really good Canadian equity fund, a really good US equity fund, really good global, toss in a couple of really good balanced, and you believe that you have a really well diversified portfolio. And there may be some truth to that, but it's when you start kind of opening the hood and taking a deeper look, you may find that the portfolios and the funds that you have may not be quite as diversified as it appears on the surface. And so it's really important to really understand what's in your portfolio. And a good portfolio, the way that I look at it, it's not really a collection of just the best funds, but instead it's a really good mix of really good, high quality, differentiated funds that when you put them together can create a portfolio that at the end of the day is going to be better than the sum of its individual parts. And by that, I mean it's going to deliver better returns with less risk over the long term. Now, when we put these portfolios together, and not just a multi-strategy, but any portfolio I've ever built over the years, we really kind of start with what it is that drives the return of a managed money product. And if we kind of take a look at the evolution of what we know about investment products, is if we go back to sort of pre-1960s, we really didn't know what it was that drove the return of a managed money product. We didn't know whether it was the manager, whether it was the market, a blend. We just didn't know. And then sometime in the 60s, a gentleman by the name of William Sharpe, you may know his ratio, the Sharpe ratio, he also developed the capital asset pricing model. And what the capital asset pricing model did was for the first time really help to separate how much of the return of an investment was driven by the return of the market and the return that was driven essentially by the manager. And so the market factor is what we refer to today as beta, and the part that's attributable to the manager rather is what we refer to as alpha. Now, in the mid-90s, some gentlemen out of the University of Chicago found that it wasn't just the market and it wasn't just the manager, but there were two identifiable factors that help explain increased return. And what they found was that small cap stocks tended to outperform over the long term, and value stocks, so stocks that are trading at a price of what they're lower than they are worth, tended to do better over the long term. So now it wasn't just the market and it wasn't just the manager. There are these two identifiable factors that help explain incremental return. And now if we kind of fast forward, there's been a ton of work done in the factor and style space. And what we found is that the market piece is still there. A part that's attributable to the manager is still there. But now instead of it just being small cap and value stocks that can help explain some excess outperformance, it is also, there's a number of different risk factors there. So there's low volatility. So stocks that don't fluctuate a lot tend to outperform over the long term. High quality stocks, so those that deliver steady, stable rates of return and grow their cash flows tend to do better. So high quality stocks. Momentum stocks, so those that are experiencing positive price movement tend to do better over the long term. Those that pay a dividend tend to deliver better returns over the long term. So it's not just the small cap and the value names anymore. There's a whole host of these. But the whole point of this is that the part that's attributable to the market, beta, is still there, and that's remained relatively constant over the years. But this piece that's attributable to the end active manager is becoming more and more difficult to find. But when you incorporate that into a portfolio, the part that a really good, high quality, differentiated active manager can play in helping you to reduce your risk and enhance your returns is becoming even more important. And so based on this, the way that we put portfolios together is really based on the premise. We know that it is the market that drives most of the investment return. So we start with the market with our passive strategies, because the passive strategies are going to give us that low cost foundational exposure to the asset class that we are investing in. Next, we're going to bring in differentiated smart beta strategies and style strategies. And what the style strategies allow us to do is really to effectively shape the risk reward characteristics of the portfolio that we're looking for. So if we wanted to be more aggressive, we could go into those particular factors that are more aggressive. If we wanted to be more defensive, we could emphasize those particular factors and styles. And then finally, we'll go out and we will find these really good, high quality, but more importantly, differentiated active managers who can help us further enhance our returns and help us reduce our risk. So the process that we use to put the portfolios together, the actual investment process, is something that I've been working on for years, and it's remained consistent. And it starts with a quantitative analysis. And this quantitative analysis really helps us very quickly and effectively zero in on a particular fund or manager and determine whether that manager is offering us something that's better or different than the broader market. If they are, then we move on to the next step, which is a qualitative review. And the qualitative review really helps us understand what the manager is doing and how they're doing it. Then that gives us the pieces that we need to put into our portfolio construction model. The portfolios are then stress tested and back tested. They're implemented and then they are monitored. And this, with the multi-strategy, truly is a cycle. This quantitative review happens every month. The qualitative review is ongoing. So in the event we see something happening with a particular fund or a manager, we are digging deeper to try to understand what it is that's happening. The portfolio models are rerun on a regular basis, usually every 3 to 4 months, and if necessary, changes are made, and we are monitoring in real time. So digging a little bit deeper into the quantitative approach, so, having spent as long as I have analyzing mutual funds and ETFs and managed money product in general, what I found is that there are certain characteristics that have been found in funds that have gone on to outperform. And so what I do is I screen for these particular factors. And what it allows me to do is really quickly narrow the universe. So if we take, for example, the Canadian mutual fund universe, I follow every month about 3,000 mutual funds. By the time I screen on these particular factors, that 3,000 becomes about 400 to maybe 500 funds that are worth taking a look at. Now, it's important to note that these are not 400 to 500 funds that are worth investing in, but 400 to 500 funds that are worth taking a deeper look at. And the reason that they're not worth investing in at the moment is we really don't know how the returns were achieved. And that's where we need to dig a little bit deeper and do our qualitative review. And at the qualitative review, it's similar to this, where we're sitting down, we're listening to, or we're speaking with the manager, and we're trying to get a sense of who they are and what they do. So when I'm looking at a particular manager, I want to understand who they are, what their experience is, what their track record is. I want to make sure that what their experience is very relevant to the mandate that they are managing. You also, if there's a team, you want to understand who's on the team, how that team functions. The next step is to really walk through the process. And I like to get a sense for, how they identify their investment opportunities, how they review those opportunities, how they decide to, size them in a portfolio, and how the portfolio itself is managed from a risk management perspective. And then we also want to take a look at sort of the operational side of things and make sure that there is a proper compliance framework in place and so forth. One of the things that I always like to do, though, whenever I'm talking to an equity manager specifically, is to ask them what kind of a manager they think they are. And it's not that there's a right answer or a wrong answer here, but really what it does is it kind of sets the table. So if somebody tells me that they're a value manager and yet they're invested in nothing but the FANG stocks, well, clearly there's something wrong there. They're not necessarily following their process or their philosophy. So the whole point of the qualitative analysis here is really to dig a little bit deeper and understand the process and make sure that there is a very strong, sound, disciplined, and very repeatable process. Because the more discipline and repeatability there is in the investment process, the higher the level of confidence I'm going to have in that management team to be able to continue to deliver the types of returns that we've experienced with them in the past. And so once we go through the quantitative and the qualitative, that provides us with the inputs that we need into our portfolio model. And the model that we run, what it does is it takes the underlying investments and it plots the efficient frontier. And the efficient frontier really shows us The combination of the underlying investments that provide the best rate of return for the least amount of risk, and it gives us that nice swooping blue line there. And so with when I'm looking to build a portfolio on the efficient frontier, I'm looking at depending on what the objective is. So, for example, with our new core with our core funds, or the ones that were launched about a year and a half ago, my objective is really to maximize risk-adjusted return. And so, in that case, I'm very likely to be kind of in the middle part of that frontier, sort of that middle green dye. Now, with the new growth-focused ones that we just launched, our objective is really about maximizing total return. So we are going to be up there on that upper right, in that upper right area. Now, when we get our portfolio mixes, what we'll do is we'll run it through a variety of back tests and stress tests and run it through independent risk models and make sure that the portfolios have the characteristics that we are looking for. Then we implement the portfolios. Now, one of the things that's important with these portfolios is that we are somewhat tactical with our implementation of this. So we will adjust the portfolio in real time. Now, it's not really a situation where I'm sitting here day trading, ETFs and stocks. I'm not one of those guys trading GameStop all day. That's not what I do. But instead, the tactical approach is really more about tilting the portfolio away from the areas of risk and tilting it towards the opportunity. So if you want to take a real simple analogy, the overall portfolio model that we create is kind of like our roadmap. If we were taking a trip, that would be our roadmap. It tells us where we're going to go and roughly how we're going to get there. But the tactical piece is really more about how we would adjust the changing road conditions. So when everything's all clear, we can hit the accelerator and we can be a little bit more aggressive and try to make up some time. Now, if things get a little bit rockier, the roads get a little bit rough, we can get a little bit more defensive and drive a little bit more conservatively. And we do this in real time. The portfolios are monitored regularly. So every day I get a sheet that shows me what my portfolios look like. I can take a look at what our performance was over the day, see what contributed to returns. I want to make sure that every one of the pieces is doing what it's expected to do given the market environment. Every month we do a really deep dive on the portfolios, again, making sure that things are performing as expected. And really what this does is it helps us to identify potential problems before they become major issues for the portfolio. Now, one of the things that always comes up is what would cause us to make a change with the portfolio. And the first few on this list are really just more a function of the portfolio management. So, we've rerun our model and the model suggests that we should add or subtract a position, or we're putting on or removing a tactical tilt, or we're doing a general portfolio rebalance. Where things get a little trickier is when we are looking at things that are a little bit more specific to an individual fund. So, for example, there's a change in the investment strategy. And a great way to look at this is if there is, let's say, for example, we're investing in an international equity fund that invests only in non-North American stocks, but the manager decides they want to bring U.S. equities into the portfolio. This is going to affect how that fund performs. But more importantly, it's going to affect how this fund performs relative to the other pieces of the portfolio. And what we want to do is make sure that we are not too correlated and there's not too much similarity between the underlying pieces. So we may have to remove one there. There could be a change in the management team. And again, that may not necessarily be a bad thing, but we need to at least investigate and make sure that we understand what the potential changes of that management change are going to be. Or there could be a change in the investment process. And some of the other ones are we're able to find a more attractive investment opportunity. And, kind of an interesting real-time example there is, if I go back and I take a look at our Canadian equity portfolio and how we performed through that February-March period, we held up pretty well relative to the broader market. We did pretty well, but when we came back out of the valley, we were trailing. Our upside capture wasn't quite what we'd expected. And when I went in and I did one of my sort of deep dives, what I found was that our low volatility piece was not keeping up. So we had been invested in an Invesco ETF, which provides great downside protection and overall low volatility, but its upside capture lacked. And so what I found is that the BMO low volatility ETF was a better fit in that it provided very comparable downside, very comparable overall volatility, but its upside participation was better. So we sold out because it gave us a better representation of what we were looking for, in that case, better upside participation without sacrificing our downside. Or we may find an option that's a lower cost. And one that I'm looking at right now is in our US equity portfolio, for example, I invest in the NASDAQ triple Qs, which provides exposure to the NASDAQ 100. Now, Invesco in the States just recently launched a new version of that, QQQM, which comes at a lower cost. So on the surface, it would make perfect sense to make this switch. However, when I look at how the two ETFs perform on a market basis, what I find is that the QQMs don't track quite as closely as the triple Qs do. And so what that's doing is bringing in an unintended risk to the portfolio. So I want to make sure that before I make that change, even though I can save the 5 basis points, I want to make sure that it's not bringing that unintended risk into the overall portfolio. So at a very high and fairly quick level, that's the process that goes into building the multi-strategy funds. And it's important to note that this process is the same regardless of whether we are building the core multi-strategy funds or the new growth-focused ETF or growth-focused multi-strategy funds. Now, one of the things that's important is all the multi-strategy funds invest in a blend of active, smart beta, and passive strategies. They all invest in predominantly external third-party managers. Now, and the multi-strategy core and the multi-strategy growth are essentially the same, but there are a couple of differences. One of the biggest is that with the core multi-strategy funds, our objective is on maximizing risk-adjusted return. So what we're looking to do essentially is to try to maximize our Sharpe ratio. With the new growth funds, we are looking to maximize total return, and we pay a lot less attention on the overall volatility. But they're still tactically managed. All the underlying investments go through our same overriding investment process. So why would we want to consider multi-strategy growth? Well, the first is really diversification, and this isn't just for the multi-strategy growth. This is multi-strategy in general. The multi-strategy funds have really been designed to be complementary to our existing internally managed value tilted funds. And the growth strategy has been designed to be complementary not only to our internally managed value funds, but also the core multi-strategy. And so what we're looking to do is find that right mix. But multi-strategy in general, just by nature, because of its exposure to the different styles and strategies, tends to provide a more diversified exposure for the investor. Portfolios are built in a very innovative way, building on what it is that drives return and really helps to contribute to the portfolio. So we start with that passive foundation, bring in those high quality smart beta products, and then those differentiated active managers. It is a relatively high conviction process, and that comes in at the optimization level, because what we're looking for are those investments that are extremely likely to be positively accretive to the portfolio, meaning that they're going to help enhance return or reduce risk. And it allows us to avoid those investments that are just bringing nothing but risk into the portfolio. And so we can build a somewhat concentrated, high conviction multi-asset portfolio. Portfolios are tactically managed, as I mentioned, which allows us to really adjust the portfolios in real time based on the underlying market environment. And with the new funds, they are very highly tilted towards growth. And you're saying, well, you know what? Hey, growth has had a phenomenal run. Why would we bring growth into the mix now? And really the big reason for that is, when I joined, the objective was really to diversify our product shelf. So we came out with the core offerings last year. This year we're launching the growth, and it's really not about necessarily capturing sort of a short-term market opportunity, but really providing another building block in the Empire Life Fund lineup. But that said, growth and value are extremely complementary to each other. Now, this graph here shows the 10-year excess return of the Russell 1000 growth and the Russell 1000 value compared to the Russell 1000 over the past 10 years. And when I say that they're complementary, I mean, you could take take a mirror rather on that zero line, and you would essentially replicate this chart. because really when value is underperforming, growth is outperforming, and vice versa. And so that makes them very strong complements when incorporated into a broader, well-diversified portfolio. So looking at this in kind of a real-time example, the blue lines represent the Empire Life Multi-Strategy Global Equity and the Empire Life Global Equity Fund. So one is core focused, one is a little bit more value focused. As you can see, we both started out at the same place and we ended up roughly the same place. But there were points in time where one outperformed the other. So the multi-strategy tended to do a little bit better in the more volatile markets, whereas in the fourth quarter, when we saw that rotation into some of the more growth names and some of the more cyclical names, the Empire Life Global Equity outperformed. And really, these essentially performed as expected given the market environment. Now, if we were to look at how growth performed, this is the the MSCI World Growth Index. It has significantly outperformed both the core and the value. But you'll also note that there is a lot more fluctuation and larger fluctuations with this green line, which indicates that growth on its own tends to be a little bit more risky than investing in a core type product. Now, to build what we would like to do is show how this could be incorporated in a portfolio. So if we took a portfolio that was essentially an equal weight between the multi-strategy global equity and the Empire Life Global Equity, that would give us that core and value piece. Now we would bring in a weight, a 20% allocation to the high growth, and that portfolio would be represented by the orange line. And you can see that over the past year, you would have earned a higher rate of return than just investing in core or value alone. But more importantly, you would have experienced a level of volatility that was roughly in line with the core or the value and much lower than what you would have experienced in the growth. So by incorporating growth, which is a higher risk, potentially a higher risk strategy into the value or core, you can benefit from that potential higher return, but do so without significantly increasing your risks. So as I mentioned earlier, the multi-strategy funds are built using the same process, and there are some differences though. So both invest in the same investable universe of ETFs, mutual funds, pooled funds. Both select investments using the same selection process. So we go through the same quantitative and qualitative review. We do the same level of due diligence on all of it. Portfolios are monitored in real time, and there's a tactical component to each. Now, where they differ is really in the style. And so with the core products, we are style agnostic. So I'm indifferent as to where the opportunities are, and we'll shift and tilt the portfolio accordingly. So we could have exposure to passive, core products, low vol, momentum, dividends. Doesn't matter. It's all over the map. We will be wherever the opportunity is. We will have exposure to all of those. Now, with the new growth products, we are very heavily tilted towards growth strategies. So we're invested in those managers and strategies that invest in companies that are experiencing higher than average rates of growth. The next difference, and this is probably the key, is on the optimization objective. So when we build a portfolio with the core product, it's about maximizing risk-adjusted return. It's not that we're afraid of risk. It's not that we're afraid of volatility. What it is we want to make sure that any volatility and any risks that we take are very likely to be highly compensated for. So we're going to be well rewarded for the risk that we take. Now, with the global growth, our objective is on maximizing the return. So we don't spend a lot of attention worrying about the underlying volatility of the underlying pieces of the overall portfolio. We are just looking to maximize return. Now, another key difference in our balanced portfolios is the role of fixed income. So in our core products, we are using fixed income as a way to help mitigate overall volatility. So we're using it as a buffer against equity market volatility. And so that means we have a healthy exposure to core products and government bonds and investment grade. Now with the multi-strategy growth, we are looking at using the fixed income sleeve more as a way to generate incremental returns. So that means we're going to have more exposure to corporate bonds. We're going to be exposed to riskier parts of the bond market, including high yield, as a way to generate that incremental or excess return. Now, doing a quick head-to-head comparison of the multi-strategy global equity with the new multi-strategy global growth, you'll notice that they are both are very well diversified across passive, active, and smart beta strategies. So they both carry a targeted 3.5% cash weight. But if you take a look at the smart beta strategies, the low volatility, quality, momentum growth, and dividends, the core product, the global equity, is very well diversified across those different smart beta and styles. Now, we take a look at the new global growth. It is growth. It is growth all day, every day. That is what this is about. It is growth. Now, when we drill down deeper and look at how these compare through the Morningstar style box, if we take a look at the core product, you can see that we are about 49%, 40 whatever. We're very heavily weighted in the core, and we've only got 32% in growth. But if we take a look at the growth of the multi-strategy global growth, we are 53% growth, 35% core. So we have a very distinct and a very well-defined growth bias. And that is something that we are going to maintain with this, because this is very much a style-focused product. Now, looking at what our model looks like coming out of the gate, we've got the NASDAQ triple Qs, which provide exposure to the NASDAQ 100, which are the 100 largest non-financial companies in the U.S. So it tends to skew pretty heavily towards technology and healthcare. Then we have international growth stocks. We have some U.S. growth. The Guardian Fundamental Global Equity, which interestingly enough is the defensive piece of the growth portfolio, run of course by GuardCap UK. Great process, strong management team, high conviction, quality growth portfolio. I've loved this mandate since I've looked at it. Then we have the iShares International Momentum ETF, and then we have the First Trust International Equity Opportunities, which is really an interesting ETF in that it invests in very recent international IPOs, IPOs have been just on fire of late, and that's expected to continue for the near term. But as soon as we start to see that moderate, we will make changes. This portfolio is going to be actively managed, and we will make changes as necessary. Now, switching more to the global balance portfolio, again, you can the Empire-like multi-strategy global balance versus the global growth balance. The target asset mix is roughly the same at 50% equity, 50% fixed income. But one thing that I'll note is that with the global growth balanced, we have a little bit more flexibility with our asset mix. So we can take our equity weight down to 45% or up to 60% based on the market environment. And we came out at 50%, and as of today, as of the last trades we put through, we are up around 59% equity. So we are running very aggressively at the moment. You'll also note that core bonds, Canadian core bonds, we run about 11% in the core fund, 5% North American investment grade and high yield, 8% in global active, and 22.5% in global passive. Now, if we take a look at the global growth balanced, there is only a 9% weight in Canadian core bonds. There's no global core bonds. We have 20% that's invested in investment grade corporates and high yield corporates, and then we have a dedicated 10% weight to high yield. So flipping quickly to the holdings, we're getting the equity allocation from our multi-strategy global growth portfolio. Provides well diversified, at least geographically, to high growth portfolios. We're using the Empire Life Strategic Corporate Bond Fund, which it invests in about a 50-50 blend of investment grade corporate bonds and high yield bonds. Provides a nice underlying yield to maturity, very focused on the short end, so there's not a lot of volatility risk there. Then we invest in the PIMCO Monthly Income Fund, which is a phenomenal, well-resourced global fixed income fund run by just a massive team out of PIMCO. Then we have our Empire Life Bond Fund, which provides us basic core exposure to government and corporate bonds. And then we have our U.S. high yield bond. And if you take a look at the quality mix, which is in the lower right-hand corner, if we take a look, you can see that more than half of the portfolio is invested in those non-investment grade issues. So we are out on the credit curve looking for that excess risk and trying to do it in a measured way. Now, that said, if things do get volatile, we have the option of moving more into core products, into core bonds, to really help to preserve a little bit of capital. At the moment, I don't see anything on the horizon that would necessitate that. However, if we start to see credit spreads widen meaningfully or overall volatility increase, we'll likely reduce our corporate exposure and bring in a little bit more of a defensive allocation. So wrapping it all up on the with respect to the new product, these are really designed to be complementary to our existing core products. The multi-strategy in general tends to combine different investment styles and strategies into a convenient one-ticket solution. All of the multi-strategy funds are built using a very disciplined and repeatable investment process, and each are actively managed with the ability to adjust the portfolios in real time based on where the opportunity set is. Next, I thought I'd take a real quick recap of the performance of the core multi-strategy funds over the past year. And remember, the objective of the core multi-strategy funds is really about maximizing risk-adjusted return. And so if you take a look at the column, which is roughly in the middle, the one that says Sharpe ratio, what that shows is how much return per unit of risk each of these funds generated. And while our one-year number may trail the peer group, we're competitive with the peer group, but we trailed the average. Our risk-adjusted numbers are much better than the average on 4 over 6 mandates. Canadian equity, we trailed, and our conservative, we trailed. But if we take a look at U.S. equity, for example, our Sharpe was 0.82 versus 0.78. On our global equity, we're 0.62 versus 0.58. Our global balance, 0.59 versus 0.52. And our global moderate growth, we were 0.61 versus 0.53. And what this shows is that our multi-strategy funds are delivering higher rates of return per unit of risk than our peer group. Now, if we take a look at our drawdown, because one of the other objectives of the core products is about downside protection. And so we take a look at the next column over, which shows our worst drawdown. Drawdown shows our peak to trough decline. And our Canadian equity fund, we were roughly in line with the category, and both down about 20.5. And with Canadian equity, quite honestly, it's a very narrow market and it's really difficult to differentiate yourself. Now, we start looking at U.S. equity and beyond. We have done much better protecting capital than our peers. So our U.S. equity was down 12.9 versus 15.4 for the category average, 13.3 versus 15.4 on global equity, 7.6 versus 8.4 on conservative, 8.9 versus 12.6 on balance, and down 10.7 versus 14.7. So in terms of our objective of protecting capital in down markets, we've done much better than our peer group. Quite honestly, where we've trailed is on our upside participation. And I think, though, if you take a look at what it is that drove market returns over the past year, it was very narrow leadership. So, for example, for Canadian equities, I'm going ballpark numbers here, so please don't quote me exactly, but I think the TSX was up something like 560 basis points. Of that, 470 was from the technology sector, and of that, about 440 was from Shopify. So if you did not have at least a market weight in Shopify, you were very likely to be left behind. In the US, it's a somewhat similar story in that the overwhelming majority of the gains came from a handful of mega cap growth and mega cap technology stocks. So if you did not have full exposure to those, you were likely to have been left behind. And a similar story with the global equity. So, once we get into a more normalized environment where it's not just one particular style or segment of the market that's driving returns, I would fully expect that we will see our upside capture improve. But I don't expect that we would see anything that would cause a significant change or increase in our overall volatility profile, nor would there be anything that would result in a significant change to our overall downside protection. So what I'm saying is that as we get to a more normalized market environment, I would very much expect to see that the overall relative returns of the multi-strategy portfolios will also improve and help deliver better returns over the long term for your clients. And so what I thought I would end off with is we'll take a look at recent positioning. So as you may recall, I rerun these models on a regular basis, typically every 3 to 4 months. And if we take a look at the last time I adjusted the Canadian equity portfolio, reran the model, there were no material changes that were required with our model. Now, in terms of our tactical tilts, if I take a look at the market environment, I'm expecting that we will see somewhat of a continuation of the trend that we saw in the fourth quarter, where it's a little bit more, not so much the value names, but a lot more the cyclical names that are likely to perform better. So we're looking to add a little bit of cyclicality into the fund. And a way to do that is to overweight our exposure to the Fidelity High Quality ETF, which has healthy exposure to the banks and some energy companies. We're maintaining a neutral weight to our index product because if you look at the Canadian equity market, it is fairly cyclical heavy with a healthy exposure to energy, financials, and materials. We're overweight our active strategies, and we are underweight our momentum and our growth strategies. And that's kind of how we're positioned at the moment. Now, taking a look at our U.S. equity portfolio, what we did here, again, our objective is trying to increase the cyclicality of the portfolio a little bit. So we reduced our exposure to momentum, and we increased our exposure to dividends. Dividends tend to have higher exposure to financials in more cyclical focused companies. And so that's a way to do that and still maintain a reasonable growth profile. We're also, at the moment, we are underweight the triple Qs. A lot of that comes down to valuation, and we'll likely be looking to add to that a little bit. We're underweight our low volatility at the moment. We're fairly positive in the near term on the overall equity markets, but we are overweight high quality, overweight dividends, and overweight our active managers mower. Now, flipping over to our global equity portfolio, looks like there's a lot going on here, but really what it is reallocating the portfolio to make way for an emerging market sleeve. So we didn't have a dedicated emerging market sleeve before we implemented these changes at the start of the year. And I think that the outlook for emerging markets is fairly positive for a few reasons. First, if we take a look at kind of the macro picture, the virus picture, the emerging markets were really kind of hit hardest, particularly China with respect to the virus. So they were the first to get hit and the first to recover. So China really now is pretty close to, if not past, pre-pandemic economic activity levels. And other Asian nations are soon recovering. So that's certainly helpful. Another positive factor for emerging markets is the Biden White House. It's going to be a hopefully more stable trade environment and a more stable macro environment in general, which should bode well for increased trade opportunities. And finally, as markets tend to settle, there is some expectation that the U.S. dollar will weaken slightly, which is going to be very positive for emerging markets. And so we added a dedicated emerging market sleeve. We slightly reduced our exposure to Europe and increased slightly our allocation to the U.S. Now, flipping over to our balanced portfolios. Again, there's a lot going on here, but if you really kind of dig deeper, it's not there's not quite as much going on here as it appears. And really what we're doing is we're looking to increase our allocation to shorter term bonds and reduce our allocation to longer dated bonds. And the basic rationale here is, we fully expect, and it's been noted by the central banks that they are likely to keep their short-term rates very low for the near term. So the short-term part of the yield curve is effectively anchored roughly at current rates. But as the economic activity increases and worries of inflation kind of mount, we're very likely to see interest rates at the long end really start to move higher, and we've seen some of that happening now. And so if we increase our exposure to short-term bonds, we're effectively reducing our overall volatility and we're reducing our interest rate sensitivity. And so that will certainly help. Now, one of the concerns is that we're giving up a little bit of incremental yield, and which is true because if I look at the underlying yield to maturity of the short-term bond ETF, it runs at about 0.9% versus 1.25 for the broader index. And so we're giving up about 35 basis points in potential yield. But if we do see a reasonable increase in interest rates, the capital loss because of the price of bonds falling would more than offset that higher yield. So we'll increase our exposure to the short-term part of the yield curve, and then as the yield curve steepens, then we can move out a little bit further we'd be in a much better position to generate a higher level of yield and reduce our overall interest rate sensitivity. So with that, I will pause, and I understand that there may be some questions. So Bruce asks about performance being below average, and how will this change, and why? And a good and part of the reason is, if you take a look at really what's driven the markets over the last it's been a long time, but really sort of last 3 years specifically, it has really been a very narrow market where it has been the big mega cap tech names and growth strategies that have outperformed. And we're in sort of our internally managed stuff tends to run a little bit more value-y. And I think as we see the recovery trades start to take place, and we start to see improved economic numbers, some of those value and cyclical names that our internal managers hold are likely to improve their performance. So I don't want to speak for them, but as sort of the as somebody who looks at funds every day, that's what we expect, what I expect. And quite honestly, if you take a look at their numbers in the fourth quarter, they were fairly decent. So there was a question there on style. MERs, somebody asked about MERs, and MERs are in line with our existing GIF framework. Ken, if you want to jump in, I don't know what they are offhand, but they are certainly in line with and competitive to our
yeah, absolutely. Yeah, absolutely. They're definitely in line with it. And I think sometimes when we get the question of why the MERs are not lower, because we have the use of the ETFs in there. However, at the same time, if you look at the underlying stocks have no management fees, and firms still charge, say, 2.5% management fee to run those. It's the same thing here. So the amount of work that you're doing, Dave, and everything is still the exact same. It's just that we're utilizing some ETFs. I'm kind of speaking ahead here on the question, but that's typically what I hear on that. So it's definitely in line. On that as well, we have introduced preferred pricing across all of our GIF segregated funds. So as household assets rise to $500,000, there's 25 basis point reduction. And again, another quarter point for a full 0.5% at the $1 million mark. And that could be multiple accounts within a household, by the way.
I think that's it for questions. So if anybody has any others, I'm happy to answer.
I guess I could say the one thing I've heard too is, like, in terms of, you look at our lineup, you're very obviously familiar with Empire's existing lineup. We put this out here because as traditionally Empire has been a value-oriented shop, and that's kind of what we're known as, and it's done Empire really well over the years. And as you said earlier, it has been out of favor the last couple of years. Had a strong fourth quartile where funds jumped up first, second quartile across the board. With the multi-strategy funds, we're really seeing this as a complement to that core approach that we have. And so as Dave combines multi-strategies and multi underlying products, it's really to diversify your book of business with us at Empire. So any questions at all? If anyone wants to type there in the chat box, you can send a message to us and we'll be glad to answer. Yeah,
one of the questions is, will I lower value exposure? I don't have any. I don't have a dedicated value sleeve in the multi-strategy portfolios, and the rationale for that is you know, I've built these really to be designed to be complementary to the existing value focused lineup. And so if you want that value exposure, you would combine the multi-strategy core product with a comparable internally managed Empire Life product, and you would get that fulsome value exposure.
A couple of other questions here about will these funds be available in the Class 3.0, Dave?
I'll just jump in. It's Jocelyn. Right now, these funds are the multi-strategy funds are available just on the GIF platform. So across our 75-75, 75-100, and 100-100. So not in Class Plus 3 or on the older elite policies.
I heard we are looking at it, but at this point, yeah, it's not on the shelf there for that.
Someone's asking about CE credits as well. Some of these questions are going probably to the host, so it's very educational. Will there be CE credits for these webinars? And of course, there will be CE credits for this. We'll send them out to you post the webinar after they've been evaluated. So we'll get that out to you. There's one from Graham.
Yeah, just reading that there. Again, Greg, I don't know if you wanted to add to that, but like, is that it's like blending funds versus index something individually? Yeah, I believe we can. You know, we can build model portfolios and build that out exactly. Yeah. Yeah, just contact your local wholesaler and say Jocelyn is BC, Vancouver area. And so I'm in Oakville here, but greater GTA, but reach out to us. You can send an email to us. Maybe I should put my email in here too. If you wanted to email me directly, I can do that and pass it along to your local wholesaler.
Looks like that's about it, I think, folks.
I see one question on preferred pricing. Yeah, it is automatic. We capture, so if you're an owner of your own RSP TFSA open account, we'll automatically add up the value of all those accounts that you own. You don't need to do anything on that. We monitor the value of that. And if they all add up to $500,000 or more, you'll automatically get the preferred pricing for every day that the value is over that. If you wanted to add a spouse or significant other, grandparents, anyone else living at the same household, there is a form for that. Due to confidentiality reasons, you'd have to fill out that form, the other person signs it, then we can link all those accounts together. So literally you could have, 8 to 10 accounts or more, all getting the preferred pricing as if they had a single account having $500,000 or more in it. So that's why we don't call it high net worth pricing, because it's literally a preferred pricing for households.
And the nice thing is that with some carriers, when you hit that certain level, it automatically moves the client into a high net worth series, but it also means a lower compensation. So it could be lower trailers for yourself. We don't change your compensation, like your commission or your trailers. It's simply when that value is reached, Empire will just rebate back to that client or to the household. And as Ken was saying, if it's the same SIN number, so if it's, John Smith and he's got his RSP, TFSA, of course, that's going to be the same SIN number, the system will pick that up. It's when we need to add in other parties with, different SIN numbers that we'll just fill out this form. I do see a question on compensation structure. So we have the usual DSC, of course, 5% gross, trailers. We have low load, which is a shortened DSC. It is a 3-year schedule, pays 2.5% up front. And then we have a newer one, which is called no load. It's an advisor chargeback series. It pays 3.5% up front, no trailer in the first year, and then trailers thereafter. And commission, so of course, front end. And then we do have right now, we've just announced a commission bonus for GIF. So this is our, GIF series. The multi-strategy are available as part of that. And with the GIF for this calendar year for 2021, we are looking at sales. So as long as you have at least $100,000 in sales, then there's a certain amount of basis points paid. It's a tiered layout. And then there's also another multiplier. So depending on your growth in sales with us this year, so gross less redemptions, there's also a separate multiplier. So it could be actually more than that existing tiered production. So just contact us for details.
Yeah.
It was sent out recently in our Insight newsletter.
Yeah, and if anyone has access to the chat box there, I did include the link to it right now. So you open up your chat, that link will be in there from me. So that should take you right to our website, so you can see the full extra commission on that.
One of the questions that's come up in the past, just because of what's going on as a result of Biden being elected, and what's going on out west, do you see that having any impact on your funds, or is there any defensive position as a result of the Keystone not happening and other things that are going on out west?
Not specifically. So again, I'm not investing in individual companies. I'm investing more in strategy. So I'm looking to combine sort of growth, growth, low volatility dividends, and so forth. So with respect to that in Canada, that's not necessarily having a significant impact in terms of what I'm looking at. Now, in terms of Biden in the White House, I think it'll be a more stable global environment. Now, there may be some repercussions down the road with the increased environmental regulations that are likely to come, higher taxation. But near term, I think the focus is really on trying to control the virus and get the world back to work. So the next couple of years, I don't have any immediate concerns. Longer term, I'm starting to, not starting to, I do have some concerns, and we'll see how that plays out. But, I think the longer this virus goes on, the more economic scarring there's going to be. And I just don't think that there is an ability for higher taxation in the U.S., quite honestly, until we can get the economy moving. There's still significant slack in the labor market, still significant slack in terms of overall production and services. So we've got a ways to go, I think, before we need to worry too much about that.
I'm going to say again, if people have company-specific questions as well, like, you can always send them to myself or Jocelyn, and we can have our portfolio management team address those, whether the U.S. equity manager, the global, or the Canadian fund managers. We're happy to talk to you on that front as well, for sure.
It looks like there's a question from Jennifer. Are the new funds available in existing GIF emblem portfolios? So in the GIF lineup, which is, across the different, 7,500 and so on, we have standalone funds, we have emblem, which are portfolios. And we also now have the multi-strategy, which are what Dave's been talking about, the mixture of the ETFs as well as active third-party managers. So yes, they are available.
Thanks for your help. Thanks for your time. This has been recorded and will be up on Win Big in a couple of days. Thanks very much for your time, everybody.
Thanks, Don. Thanks, everybody.
Thank you. Have a great day.